All right. Well, good afternoon, everyone, and welcome to our 2024 annual Outlook webinar, Managing Your Wealth, What to Know for 2024. I hope everyone's year is off to a great start. My name is Dana Vosberg. I'm the Managing Director of Advisory Services here at Manning & Napier, and I'm happy to be joined by two awesome colleagues today. First, Chris Petrosino, Managing Director of our Investment Policy Group. Chris and his team are responsible for setting the firm's overview on our broad macroeconomic outlook, as well as on the financial markets, both equities and fixed income, and home and abroad, and on asset allocation decision making. I'm also joined by Robin Iacovetta, a senior financial consultant on our wealth management group, based in Atlanta, but covering the Southeast region for Manning & Napier. She has over 20 years of experience in the financial services industry, providing planning strategies and investment solutions across a full array of client needs. So thank you, Chris and Robin, for taking part in the webinar today.
Thank you.
Happy to be
Looking
here.
forward to it.
Yeah. And as we get started, it would be great to know where everyone is joining from today. So we like these events to be interactive, and so please feel free to type in your location in the chat section. It's always interesting to know, where people may be tuning in from, so to speak, and who we're reaching. Chris and I are both in Rochester, New York, I guess Fairport to be exact, but and Robin, you're in Charlotte today. You go all over the place, but you're in Charlotte today, right?
Yep, I'm in Charlotte today, and you guys were both giving me a very hard time last week because we had quite the ice storm. That's what happens out here in the Southeast. Okay, so we don't get as much snow, but the ice, you just can't drive on it. And everybody in Rochester was giving me a hard time. Like, no, I'd rather have snow.
Yeah.
Ice is awful. I had to cancel all my meetings in Alabama last week because of the ice storm. So luckily, all my people stayed safe, but it wasn't pretty.
Yeah. Well, I'm seeing a lot of different locations coming in the chat. Also, a lot all over the place. So yeah, lots of southern locations, but out in California, Columbus, Rochester, all over. So great to see where everybody's tuning in from. Thank you. We also encourage, I mentioned being interactive, but we encourage questions along the way. So if you have questions at any time, please feel free to submit them using the Q&A function that we have. We'll spend time at the end of the webinar answering as many questions as possible. We received a lot of really good pre-submitted questions. I'll just note, though, sometimes certain questions can be a challenge to answer on a live webinar, either because it can be very specific to an individual's planning situation, or maybe we just prefer to do a little bit more research before answering. But we just know that we or someone on our team will be sure to follow up, answer your questions if we don't answer it live. So, but thank you for those who did send a question already. All right. So we're going to have a really good discussion today. It serves as a nice kickoff for 2024. Hard to believe we're already through almost January here, but we'll certainly cover important topics and tips that apply for the next 11 months and beyond. And as you all know, one thing that's very common with the new year is New Year's resolutions, or even if you don't have resolutions, it's a really good time for a status check across all areas of your finances. And we can break those down into, I think, 3 categories that you see here. The first being the housekeeping items for the year, really basically revisiting personal administrative details that may seem minor, but can be extremely important. There's also wealth management priorities and things that you should be thinking about from a longer term planning standpoint. And then there's the environment that can impact things, the economy, markets, which often don't move in unison. But so a lot of important things to think about. And I guess, Robin, I'll just start with you. Are there specific areas here, ideas, tips that you like to highlight with clients?
Yeah, one thing I'm really passionate about and comes up in so many meetings, but the good news is it's so easy to fix yourself, is beneficiaries, right? A lot of people will think that they have a will, they've got all their estate planning all tidied up, which is fantastic. It's very important to have a will, but you have to remember that a will does not cover any kind of a contract, right? So the most common times I see this happen is employer plan at work, 401k, or an IRA. Your will does not cover those. Those are contracts, and you have listed beneficiaries. So I would suggest at least once a year, pull that up, find out who your beneficiaries are. Make sure you also have contingent beneficiaries on there. A lot of times you can just fix it right there online.
Yeah, perfect. Yeah, and I think it's, with some of the other areas here, it's just you make your way through the holidays. Now, for a lot of times people may kind of put things off to the side. Now we're moving into, tax time, at least for the 2023 tax year. So, really a good time to just gather everything together, take a look at things that maybe, you thought, oh, you had it covered at one point, but it's been a few years, and now it's a good time to just make sure you take a look at everything closely and address any of those areas that need to be sort of refreshed. Or maybe there's been a change in your life and it's really important to to review everything comprehensively and to make some meaningful changes. So in this, that's a good intro, I guess, for this section, where I think we're going to really get into more details and ideas and cover some thoughts on planning. But I think the first thing I want to do is ask, and please feel free to chat this in. What is your main financial concern for 2024? And we'll probably touch on some of these, but just it's interesting to know what people have in mind and what's on people's minds for, major challenges, things that they're thinking about, and that you'd like to share. So we can take a look at what's coming in, and then we'll sort of give our thoughts.
Mm-hmm.
So yeah, I see, some concern about sort of maybe issues with losing money with investments, coming recession, election.
Mm-hmm. Yeah, Fed changes.
Yep.
Yeah, Fed and interest rates.
Yeah. So Robin, maybe, you had a good way of approaching some of this when I think that this all points to uncertainty. That's people are always, that's the biggest problem, right? It all kind of boils down to uncertainty. And
Right.
so when you're talking with your clients, how to kind of address some of the things that are coming in here.
Right. Well, Dana, you and I as planners, what's interesting, we're working with individuals and everyone has a very unique circumstance. And what I like to talk through with people is there's two factors, right? There's two things that you have to balance out. First of all, you really want to start with yourself, your own financial plan, your budget, your goals, right? Start with what you can control, right? So we're always starting with the end in mind, right? Are there long-term goals like retirement we're trying to save for? Is there a short-term goal, a new car, putting one of the kids through college, something like that? And really start with that, because those are things that you can control, you can map out. And that does give you peace of mind. The second part of that, of course, is the external factors that we can't control. We would all love to. All these questions, I would wish I could say on September 19th, there's going to be a recession, and then you want to buy everything. We all wish we could, because we all love to see our clients do as well as possible. And that's where I feel, Dana, I don't know about you, I hear the most concern. What is the Fed going to do? What's the election going to do? What is, are there going to be more bank failures? And that's what you're melding into your own individual plan and trying to make a comprehensive wealth management organization.
Right. Exactly. Well, Chris, can you maybe touch on some of those, a lot of those comments that came in were related to, the economy and the market and just sort of the uncertainty that goes along with that. Can you kind of provide your own thoughts there on, we're talking about, challenges that may affect the financial journey here going forward?
No, absolutely. Yeah, I think the good news is we start 2024 is, it was a surprisingly strong 2023, a year where I think most folks, the markets were helpful towards your ultimate financial objectives. So we're starting at a point where, despite what we saw at the start of last year and really throughout the year, is some potential for volatility in the markets, not the least of which just observing what's been going on in the in the economy, both domestically and internationally, markets found a way to go higher throughout the year. So, we start in certainly a much better place than where we started in 2023. You think about 22, that was a year where both stocks and bonds, basically declined by about the same amount as we, particularly longer term bonds. And so, as we start this year, I think so with that, sort of good news banked, we're still in an environment where we see the economy dealing with, one of the, historically most aggressive rate hike campaigns on the part of the Federal Reserve. We've seen, lending continue to slow. We're seeing, particularly on the smaller business side, companies struggling, with higher interest burdens on variable rate debt. And all this comes at a time when I think if you look broadly across market pundits, financial media, expectations are almost uniformly for a so-called soft landing, which is to say that inflation continues to moderate towards the Fed's 2% target, which enables them to cut interest rates materially, easing the pressure that folks and companies are facing due to rates, and growth can continue to bump along at a sort of Goldilocks, neither too hot nor too cold. And that is the widely held view in the market at this point in time. We look at how markets generated the returns last year was almost entirely, if we're talking in aggregate, on the back of higher valuation, which is to say that investors, over the course of 23, were just willing to pay more for those same dollars of earnings. So as we look, out further, we're finding opportunities in individual companies, areas of the market, but broadly speaking, we think it's it's a pretty good backdrop, particularly after 23, to speak with folks like yourself, Dana, and Robin, and just make sure that your financial plans are are in a good spot here.
Yeah, it's so interesting the comparison between 2022, which was just a horrendous year for stocks and bonds, and then 2023, where the overall consensus was we're moving into a recession, at least a soft landing, and it turned out to be really a phenomenal year. And sometimes I feel like, and I know my clients feel like this too, it's that opening scene from that movie Office Space when he's going to work in traffic and everybody's passing on one lane. Everybody else seems to be doing this and getting ahead, and you finally get into the other lane. You switch your plan, you do something else, then your lane starts moving fast. And it's interesting because in 2022, I was talking to a lot of people who were saying, should I switch lanes, right? This is our plan, but wait, maybe I should put it in cash. Maybe I should put it in T-bills. And the people who stuck with the plan were rewarded in 2023. But the interesting conversation I'm having now is you're looking at your investment account, maybe you're looking at your 401k, and you're seeing double-digit returns in a plan where, typically it's, maybe 7-8% returns, right? Same respect, don't count your chickens before they're hatched. Don't get too over enthusiastic and just, again, stick with that plan that takes all of these unexpected things into consideration.
Right. Oh, that's good point. And so, Chris, one thing that we've been, obviously, inflation's been a huge topic here for a couple of years now, and I think that's just good to revisit that, and it's on a lot of people's minds. So, can you just touch on kind of the outlook for inflation here, as we've seen it's been high, it's come down a bit, but like what does that mean going forward for people?
Sure. So over the past, really 12 months or so, we've seen a pretty good slowing in inflation, and whether you're looking at sort of the headline consumer price indexes or the more stable core indexes. So here we actually just have the year-over-year rate of inflation sampled from the peak in September of 22. So this is the core stripping out food and energy, which again, this just gives you a sense of maybe more of the underlying inflation pressures in the economy. And really what we've seen here is pretty good sort of taming of inflation on the goods side of things, right? So, early on, that big boom in inflation after as the world started to reopen from the pandemic was really on the goods side. Additionally, some of the supply chain issues that were occurring in many many corners of the world. So as those things subsided, we've been able to see inflation tick tick down fairly substantially. Our expectation is going forward. It's going to be difficult to see, inflation come down materially from here without some easing of pressures on the wage front. Now, typically that tends to happen with an economic downturn or recession. Outside of that, generally, wage growth tends to remain pretty sticky. So we think from here it's going to be likely tougher sledding, and then more recently you're starting to see some supply chain issues bubbling up again. And these are in some ways different than the last run of them. Now it's largely due to shipping. Certainly the events in the Red Sea, as of late, on a geopolitical front, you've seen dramatic decline in cargo going that way, but then also the Panama Canal, where due to some issues with water levels, we've seen a dramatic reduction in freighters going that way too. And so when you I would say choke off, but throttle down two of the main avenues for global trade, and the alternatives are going around the south of Africa or the south of South America. Those are again, potential for some more noise going forward. You try not to bake those things into your expectations, but if we're looking at trends and saying, are they getting better, are they getting worse, that's probably one that's that's getting a bit worse on a short to intermediate term time frame.
Yeah. And the inflation, I know the numbers have come down, but I feel like most of us are still feeling that inflation, at least day to day, and things like our grocery bill. And it doesn't seem to capture the real inflation that we're experiencing. That, for example, the 3.9% number, Chris, can you speak a little bit to where are they getting these numbers?
Sure. So we could spend the rest of this webinar, indeed the rest of the day, debating the merits of how the government divines what the inflation rate is in the country. But it is intended to be a representative basket of all the items that consumers purchase over time. Now, certain things like groceries, we're buying every week, every day it seems. In my family with three teenagers now, but it's those are the things you feel. Those are the things that in your inflation is stated on a it's an annualized rate of change, whereas your point of reference might be, well, I was able to buy this milk for $2 2 or 3 years ago, and now it's $3 or $4. I mean, we had that price spike in eggs a year or so ago, and so your point of reference is a little different as you're buying those things more frequently. And then there's other items in your CPI basket. My day started very early with a 6 a.m. trip to Home Depot to replace a garbage disposal, which is a lot. It felt like the price doubled. Now, of course, the last one I put in was probably 8-9 years ago. So there's those types of things too. So your experience can be very different, and we see that in some of the consumer sentiment surveys, where folks are very, very concerned about inflation, and again, rightfully so. And I think that's it shows up in various polls on the political side of the world too. And so this is one measure of it, but we think about more, I think, even on the planning side, or what are the costs that matter most to you, in your families, and that's can be at times very, very different than what's in the consumer price index.
Great. Well, I just wanted to mention, we see questions coming in the Q&A section and the chat section. So thanks for sending those in. We will definitely get to as many questions as we can toward the end. So I just wanted you to know that we're seeing those. So we appreciate that. So I think we're talking about some of this is, again, back to the idea of some of the uncertainty and maybe challenges and concerns we're seeing. I think one one thing that we've heard a lot from clients is, and this is common, right? It's after some extreme swings in the market. And Robin, I think you touched on, right? 2022 was bad year across the board. 2023, very, very strong year, right? And we had a number of strong years. I mean, going back to kind of the wild swings we saw from the COVID crash and then the quick recovery there. And so, but I think a lot of people have been asking, it feels like because of these swings, we should make an adjustment, we should make a change to the asset allocation. Some of that's timing, but I guess when that question comes to you, Robin, should I change my asset allocation? Touched on it a little bit before, but could you kind of speak to that more?
Yeah, exactly. I get a lot of questions on, should I change my time horizon? Should I change my asset allocation? And again, we really want to start with the end in mind. What are we trying to accomplish? What does that number need to be? And then work backwards towards what are we saving now and what are we investing in? So, what I find really interesting and what makes this job so fun is you might talk to one person that says, okay, I want to retire in about 10 years with $100,000 of income every year in retirement for the rest of my life. But this might be a person that just couldn't sleep at night during 2022. News about the stock market, news about the bank failures. It really was causing a lot of anxiety. Well, somebody like that just shouldn't have too much of an allocation to stocks and things that are going to keep them up at night, right? We really try and diversify as much as possible, but be sensitive to that risk tolerance. Now, with that said, that particular person is going to start saving a little earlier. They're going to have to start saving a little more. Maybe they retire later. Maybe in retirement, they take out a little bit less because I'm going to have to put them into safer investments, fixed income investments, things like that. Now, they might have a twin brother, and that brother has the exact same goal. 10 years, $100,000 every year. But that person, maybe he's one of my Coca-Cola executives here in Atlanta. He's used to having stocks. He's had a 401k since he got out of college. He's very comfortable with a stock allocation. We can work around that risk tolerance. So I think what's actually really wonderful is there is no right answer for everybody. It's really particular, but you do have to make some concessions based on your risk tolerance.
Right. And I think, from an asset allocation standpoint, you don't necessarily just have to have one, and there's different pools of money that you may be managing for, right? If a lot of people will have a retirement plan, and if that rolls out into an IRA after retirement, or they have personal taxable money that they have in addition to that, and because there may be different time horizons and different uses and purposes for that money, you may have different asset allocations for each of those, and you should actually. I mean, based on what the situation calls for, and again, going back to, you have to build in the risk tolerance and your own comfort level there, but there's going to be a need to sort of understand the purpose for each of those buckets and set that asset allocation appropriately for each of those. It's not necessarily a one size fits all just because of your particular age or where you are in life that you have to have an asset allocation. Obviously, it needs to be very specific to your own goals and personal needs. I think that one thing we wanted to point out too is, I mean, technology is helpful when it comes to a lot of this, understanding, having context, understanding what you can control, understanding the impact of trade-offs and the impact of different decisions. Having different tools that you can use. We use a really good financial planning tool called Money Guide. You can see on the screen here, there's something that they have that's called My Blocks, which is just sort of short, small bite-size training planning tools that allow you to take a look at certain areas, kind of dig into them specific to that planning area, get a little bit of context, understand it a bit better, and so that's available to clients, if they have access to the client portal. So things like that can actually help quite a bit, I think, for people to feel better about some of this when it comes to uncertainty, certain ways that different planning decisions may impact their broader plan.
Yeah, and there's all kinds of fun links in here that you can get in there and play around with. We got a great question before the webinar about, should I take my Social Security earlier or later? Well, again, you can get in there, play around with it, see how it affects your plan. Budget, there's a great budget template. I would say there are two things we can say across the board for everybody. Start out with a budget, review it at least once a year. There's so many apps and great programs now on your phone that can help you track your expenses whenever you use your credit card or your debit card. And number two, and Dana, I think you mentioned it at the beginning in housekeeping, emergency fund. 3 to 6 months in an emergency fund. And now in this high interest rate environment, right, savers are rewarded. So you can have some money in that emergency fund and it could be earning over 5%, right? And I tell a lot of people, hey, don't park it in checking and savings right now. If you have that emergency fund money, be sure and put it in a money market, CD. There's a lot of great options out there. So at least you get a little bit more return on that. Again, it's an environment where savers are really rewarded. Anyone with debt, especially credit card debt, variable debt of any kind, is in a tough spot, right? That's in double digits. So part of the budget, look at all those, see what you can consolidate as far as debt.
Great. Well, I think if we want to really take a look at longer term planning considerations, that's what we have here. Is how can I save, grow, and protect my wealth? And so, Robin, I think as you're talking with clients, there's a lot of housekeeping items, some of the things we're talking about, near term uncertainty about the market, all of that, that's sort of a shorter term conversation oftentimes, but I mean, the asset allocation conversations obviously should be, longer term or certainly out at least the intermediate sort of length of time. But when you're thinking about real planning discussions, what have you talked with clients about there when it comes to kind of longer term
Yeah,
strategy?
honestly, one of the best things that you can do is keep up with tax changes and how they're going to affect your income, your investments, and your estate plan. It's funny, and we've already gotten a lot of notes in the chat about the ETF and the new things coming up. I get questions about commercial real estate, all these fun investments you can do, but sometimes the way you can make the most money is the most boring. Look at your tax return, right? Because I tell people, if you can save $10,000 on your taxes, that's just as good as making $10,000 on your investments, right? So really take a look at that, go over that with your accountant, look at your budget, because it's really amazing how much you can save. And with that said, I am going to give a shameless plug to my colleagues that are amazing in the tax department. We are doing a tax webinar coming up on Thursday, January 29th, which is going to go into a deeper dive. It's going to cover some of the tax changes, the estate tax sunset, just some really good tips that can apply to everybody across the board on some ways to save and ask a lot more in-depth questions about that topic.
Yeah, and I think looking at what we have on the screen here with some key considerations, I think there's also, we have relating to taxes. I mean, certainly there's the Tax Cuts and Jobs Act that will be sunsetting at the end of 2025. That's from a time frame standpoint. There's some urgency in understanding, well, what does that mean? And then we've talked a lot with our clients about, especially with larger estates, there may be a real opportunity missed if you don't do planning now before that sunsets, because the estate tax exemption is set to be cut in half. And so not only that, I mean, estate tax is not something that impacts, it only impacts a very small percentage of the population. But even so, the Tax Cuts and Jobs Act reduced taxes across the board and impacted everybody. So taxes will be less favorable once we move into 2026. And so it's important to understand what those changes are, some planning considerations around that. And that's a topic that will be covered in that webinar. But, I think a very important thing to talk with, that we're talking with our clients about, any planning that you're doing right now, thinking about, what does that mean in the near term here to get ready for setting some strategies for the longer term.
Right, exactly. Because those tax brackets for the income tax are going to be going up if that sunsets. So there's a lot of things you can do now, whether it's gifting more during your lifetime using the annual exclusion. If you're in your 70s, maybe you take a qualified charitable distribution from your IRA. Once you're 70 and a half, a lot of people don't realize you actually don't have to be the new RMD age, right? For a lot of people, that's now 73 or even 75, depending on their birthday. As long as you're 70 and a half, you can give directly from your IRA to your favorite charity. You know, people that have IRAs with us will do it for them. And that's not only reducing that IRA, that taxable estate, but future required minimum distributions that might be in a year when those tax brackets are higher.
Yeah, great. Well, good. Well, I accidentally jumped ahead there, but I on the slides, if you noticed, but I went back, but I wanted to cover first one of the first poll that we have. We have a few different polls that we'll be pulling up here, but the first that I would like people to participate in is which area do you want to become more financially confident in this year? So after we talked about some of these planning ideas, you know, which area do you want to become more financially confident in this year? And your choices are formalizing your financial goals, stress testing your plan, implementing strategies to be more tax conscious, protecting your wealth and legacy with an estate plan, or maybe something else other. So we're just interested to see what people select for this one, and then we'll move on to the next section.
Yeah, it's really helpful because we want to definitely address the concerns that are first and foremost on your all's minds right now.
Yeah. All right. See, hopefully everybody had a chance to, or most people had a chance to select one there and see what the results show us. All right. So pretty well distributed here. So protecting wealth and legacy with an estate plan is actually, you know, just came in just ahead of formalizing your financial goals and stress testing your plan. So that's good though. I mean, I think it shows that, and even implementing strategies to be tax conscious. I mean, pretty meaningful or good, you know, distribution there across those different areas. So good to know that it's areas that we understand are very important to clients, and we absolutely want to focus attention on that. So next section we're calling fact or fiction. This is where we kind of move into the quiz show portion of the webinar. It's we have, like I said, we have some polls, and I think it's fun, but we'll be bringing up you know, certain topics that are likely on a lot of people's minds. I think based on what's been chatted in and some of the questions that, you know, we know we're hitting on a couple of the you know, some of the topics that are on top of mind for people. But so we'll pose a couple of those, and Chris or Robin will give their perspective on whether there's some truth to the statement or maybe not so much. So the first one, you may be aware, is we get to vote for President of the United States in 2024. So that's something we get to do this year. So the question that a lot of people, I think, kind of have in their mind, or the issue on a lot of people's mind, is presidential election years are riskier times in the market than other years. And I think I saw somebody in the chat actually, or question, kind of mention that as a concern or just a question. So curious what people think, fact or fiction, on that particular issue.
Yeah, it's an excellent question.
We'll see what people think here. Hopefully, wait 1 second while we get the results, and then we'll have Chris weigh in.
And if we could get $1 for every political ad we're about to see, and we could put it in a retirement plan, we wouldn't have to worry about any of these factors.
So fiction won out, and I think, Chris, what's your vote?
Sure. No, in terms of just empirically looking back over time, you know, you'd be hard pressed to say that presidential election years, or really election years broadly, are you know, any more volatile or, you know, skew towards, you know, dramatically different you know, return outcomes than the you know, all the other years out there. You know, so here, you know, one way we went about this, just going back to 1928, looked at presidential election years, and, you know, what we found was, you know, results are very, very similar to all other years, right? I mean, on average, stocks go up, and presidential election years on average up about 11%. All other years a little bit more, but, you know, nothing you know, what I'd call statistically significant. And then, you know, you actually had more positive years in the election years. And so I take nothing from this in terms of, hey, we should, expect a great year in stocks, we should expect a terrible year in stocks. Just inherently the distribution of outcomes, what the risks are, really aren't that much different than any other year. There are very good years in presidential election years. There are very bad years. A great example, 2008 election year, global financial crisis. 2020 election year, we had the pandemic, but still the markets went on to actually achieve a new high by year end, despite falling by about a third through March and into April of 20. Even 16, where a lot of times we say markets don't like surprises. Well, I think relative to a lot of polls, 16 was a massive surprise. And again, you had higher highs. There's actually a question that just came in that I'll address about like nearer term measures of volatility around elections. And so, in preparing this this graphic, I actually went and looked at, well, okay, year's fine, a lot of things can go on in a year, but what if we just looked at the fourth quarter of every election year? So we're going to capture October, where in some years it was pretty clear who was going to win or not. November and December, where you're going to get more surprise in the aftermath of that. And what we found, and we can certainly follow up with more details, but distribution of outcomes very, very similar. You would be hard pressed to say that the odds of something catastrophic happening were any higher in any of those individual months or the quarter as a whole. And then the other way that you can segment this, the other question that you get, and we've tackled it varying ways, is, well, what if it's Republicans or Democrats? Republicans sweep, Democrats sweep. This party gets the Senate, this party gets the House, and basically, you tell me which party you're rooting for, and I can show you numbers that make them look better. And I joke, but it's the truth, depending on how far back you go or exactly how you slice and dice the numbers. And for me, I take away from that is, again, generally, while there may be some volatility around the election day, history would say otherwise, but it's more the fundamental factors and what's going on in the broader economy that tends to dominate things. So never say never, but if we're looking at just about 100 years and plenty of surprises, volatility, world wars, you've got a depression, a global pandemic, financial, you've got a lot of stuff going on here, and the outcomes really are quite similar.
Yeah. Good. All right, thanks, Chris. Next fact or fiction we have is obviously rates were extremely low for a very long time, so that they've moved higher here over recent years. So with higher rates, should I go to cash or money market? So should I move more money into cash or very short-term investments? Fact or fiction? So interesting. Give people, again, a chance to think through that and make a vote.
Yeah, this is an excellent question that's been coming up more and more with interest rates being at a high we haven't seen for quite a while.
Yeah. See what we have here. Looks like fiction. Okay. You know, yeah, almost 3/4 of people voted fiction. So again, we'll give our take on it here. Oops. There you go. Chris,
I'll start, and then Robin, if you want to weigh in. I think we get this question put to us a couple ways. One, just relative to holding any longer dated fixed income. Why buy a 2-year? Why buy a 5-year? Why buy a 10-year? Why hold these in my portfolio when I'm getting a higher yield on my money market or a 1-month treasury bill? And the answer is that those short-term rates are just that. They are good for a very short time. And as interest rates adjust, if we look at the Fed funds futures for the year, you're pricing in about 8 quarter point cuts, so 2%. So to the extent that the futures market is correct, you can expect the yield on those short-term savings to go from something that starts with a 5 to something that starts with a 3. And so that's not a forecast of what's going to happen, but that's an illustration. And so, in that type of environment, you'll see the rates on your money market reset lower and lower. And certainly anyone that's been saving for a period of more than just a handful of years, certainly you can remember rates I can starting in the 2000s at similar levels, getting to basically nothing if you left it in your checking or savings account. And so that in those environments, you all of a sudden owning some longer maturity bonds that today maybe yield 4.5, all of a sudden that becomes more attractive as those rates fall. And so, for folks with, anything more than, shorter term liquidity needs, we would, we would invest you with a mix of maturities to benefit from the potential for falling rates. And so it's not, the answer to things are rarely all or none. I think the same applies here. Certainly, if you have needs in the next 30, 90 days, we don't want to take interest rate risk. You want to make sure that the funds are there, and that's a pretty clear planning case where short term makes a lot of sense. But the further out that your needs go, the more you want to think about matching them in terms of how your portfolio is positioned.
And Chris, I'll play devil's advocate, because one question I get quite a bit was, okay, why would I not do just all 3-month T-bills, 3-month or 6-month CDs? Because even 8-month, 12 months are paying less. Why would I even use any of those? Because I'm locking in this great rate right now.
Right. And so, we say markets are always forward-looking, and that's whether we're talking about the stock market or the bond market. And the reason that 12-month CD is yielding less than the 6-month is that is the market's way of pricing in expectations that month by month over those next 12 months, particularly in months 7 through 12, that we're expecting lower rates. And so that is the market just pricing in those expectations today. Now, certainly they don't have to be right. They could be wrong, but it is that's why you're seeing that lower rate. And to the extent that the market forecast is spot on, you're basically going to be indifferent from owning that 6-month CD and in 6 months' time rolling it to another 6-month CD, but it's going to be at a lot lower rate, or just buying and holding that 12-month CD. So that's why it's showing you where the market is expecting rates to go. So it's not that one's a good deal, one's a bad deal inherently. It's really it ultimately is a function of where do rates go and what someone's view on the direction of rates are.
Exactly. We wish we had a crystal ball to know what that next rate is going to be, but we don't. So, yeah.
And, just the other thing that we've got on the screen here just looks at sort of given high rates on cash, maybe you don't take risk in the stock market. And here we show what the impact was of moving to cash at various market lows over time against the S&P 500 going back to 1990. And it goes without saying, if you go to cash at the lows, you miss all of the upside. But I think you could also draw this by extending lines. Well, what if you got out at the highs? What if you got out in March of 2000, or I think it was October of 2007, or right in at the start of 22. And in each of those cases, you avoided the subsequent downturn, but over the long run, you'd be far worse off just sitting on the sidelines in cash. So again, this just speaks to the importance of aligning, the risk that you're taking in the portfolio with your risk tolerance and time horizon. And for really all but liquidity or the extreme risk aversion, it's really hard to make a case to be trying to go all or none out of the markets and into cash.
Yeah, you have to get both sides right, both getting out and then getting back in.
Absolutely.
That's a compelling chart there. Yeah. So next one then, we will cover what became popularly known as the Magnificent Seven. So a lot of attention last year on the group of companies that kind of fall into that. A lot of tech companies, and So as you see here on the screen, without reading every single one of them, it's will that Magnificent Seven, will they remain magnificent is the question, fact or fiction. So it'll be interesting to see what people think about as we look ahead after obviously a strong year for those companies and those stocks. What is it? How should we think about that for the next year? See what the results show us. So yeah, so more fiction than fact as far as the votes go, a little bit more, but yeah, I think this can be, it's an interesting one to dissect a little bit, Chris. So you're saying
Sure.
fiction.
So yeah, we can approach this from a couple ways. One is, this idea we just put it out there in the text, but right, great companies are not always going to be great investments. And I say that knowing that we hold a number of these companies actually in many of our portfolios, and so our view is at this moment they line up both is great great businesses, and also still at valuations we think make sense, but over time, as you'll reach points where either the valuation no longer compensates you for the risk that you're taking in these businesses. And what tends to happen, right, is you can have a business that goes from being amazing to just slightly less amazing, but because of where expectations are, because of what the valuations on it are, that could be a very painful experience in terms of what investors are willing to pay for those businesses. And just as a way to sort of illustrate that things generally don't don't grow to the sky, and things don't last forever. So we just went back 20 years through year end and said, well, who are the top 10 companies, 10 largest stocks in the U.S. and where are they now? And with the exception of Microsoft, the rest are out of the top 10. AIG had a near-death experience back during the financial crisis, a shell of its former self. But you run through this list, some kept the top 25, number moved out of the top top 30. You see some 40s, some 50s, and beyond. And it's again, in this particular group, they're all still in business, many still, very, very good, very profitable businesses. But it's just to say that over time, the fact that these are not still holding their spot in the top 10 means that others pass them, right? It doesn't mean that these companies aren't up from where they were 20 years ago, but others are up more because they're able to surpass them. And so, keeping things like this, in mind helps, helps give some perspective where there's lots of opportunities out there, both, within the U.S. So we've got this, Magnificent Seven group, and well, just in the S&P, that means there's 497 others, nipping at their heels, trying to catch them for, the top of the table in the S&P. And, beyond that, there's, few thousand other publicly traded opportunities here in the U.S., not to mention what's abroad. So I think it's important that we can have great businesses, which I think most would agree these companies are. But it's important to keep an eye both on what you have to pay for them, as well as there are going to be other opportunities out there, and we're always looking for those.
Yeah, everything in moderation, in a sense. Don't put it all on one horse. Well, and what's interesting is, people can do individual stocks, you can do ETFs, you can do mutual funds. So you might talk to somebody and they say, well, I don't have too much in those stocks. I've got a S&P 500 index funds. And that's great. But the thing that people forget, especially, it's so interesting, if you look at that kind of a fund in history, those pieces of the pie, right? Those 500 segments in that fund, they're not equally weighted. Those are market cap weighted. So Chris, you probably know, but I think it's something like 28% of a typical S&P 500 index fund, and that is its job to follow the index by market cap, is going to be overweight, right, in more tech than you might realize that you have.
No, it's a great point. The success companies have enjoyed in the market is gotten to a point just from a calculation basis that the index has become, quite top heavy. It's great so long as they continue to do well. But if they stumble, that is going to, I think what many think is a diversified exposure to stocks, all of a sudden could feel, very, very concentrated. And I think when you
Mm-hmm.
contemplate companies being 6, 7, 8% of a portfolio, if all your portfolio is the S&P 500, that's a pretty concentrated position. That's the type of levels where our risk officer here at the firm, he would, if I had a portfolio with that type of exposure, he would be pounding on my door, making, we'd have some discussions about position sizes. So it is, while it sort of is under the veil of this diversified index, it's worth being, mindful of what you own. And, I can say that, I'm part of a team where we do some allocation using exchange traded funds. We use the S&P 500, but when we do that, we're mindful of what we're getting from a concentration perspective. And, in many cases, we will actually, try and, retune that a bit using either an equally weighted index, so you own all 500 companies in an equal weight, or some that tilt to areas of the market where these companies aren't. So it is important to think about diversification beyond just the S&P or the benchmark. It's a great point.
Well, I think as just a way to kind of conclude our prepared portion, Chris and Robin, can you touch on a few key points that you think are worth reinforcing as we start the year? Just things that just kind of highlight here as we kind of wrap up our prepared portion. Chris, we'll start with you. Yeah.
Thank you. So I think end is as I started, we begin the year at a great point in the markets in terms of what 23 gave us. Certainly it exceeded my expectations by by a decent amount, but it doesn't change the fact that we continue to see many signs that that the economy is slowing, whether there's signals from the labor market, some of the more leading factors. We continue to see rising bankruptcies, particularly at smaller firms. So not a lot of headline grabbing stuff, but a $50 million default here, 62 million there. You're seeing that. We're seeing it enter into some of the business surveys. We're seeing fewer people quitting their jobs in search for rosier opportunities. But against this backdrop, we have pretty optimistic sentiment. There's not a lot of concern out there that things are going to go that things could go wrong. Doesn't mean they will, but we think against this backdrop, it pays to be very conscious of what you're owning. In our portfolios, we're taking a bit less risk than maybe our midpoints of our policy ranges, but we think that's prudent given where we are, and working on what we want to own. Should we see some volatility, and being able to take advantage of that on your behalf.
Yeah. Robin, any thoughts for you quickly?
Yeah, I would say a common question is, what should I be worried about? What's the biggest danger in the US economy today? And I say the biggest danger is, number one, you not having a plan. And this is why I say that, because we can't tell you if it's going to go up or down, or interest rates if they're going to go up and down. But if you have a plan, you have a choice, right? If the market goes down, well, we have a plan. We're going to do tax loss harvesting. Maybe we do some Roth conversions. Maybe we rebalance your portfolio. If it goes up, okay, well, then we're going to give some highly appreciated stock. We're going to do some strategies where we rebalance from that perspective. And remember, whenever people say the market is up or the market is down, if we're talking about, say, the S&P 500, not all 500 are up or down. That's when we're getting in there and saying, okay, there's going to be certain sectors that are doing better or worse in certain economies and certain interest rate environments. So again, starting with the plan, you're going to know what to do no matter what 2024 throws at us.
Great. Well, thank you, Chris and Robin, for your insights. So we're going to move into our open Q&A, and we'd like to highlight again, if you have any questions after the fact, feel free to reach out to speak with your financial consultant. If you don't currently work with one, contact us, and we'll be sure to have someone reach out to you. So let's get into the Q&A. As I mentioned, there were a number of questions that came in, and as I touched on earlier, we'll aim to select questions that I think are broadly applicable to the audience, just to make sure we're kind of hitting on the main questions that have come in, or some of the common ones, I should say. But please submit any and all, and if your question is not answered, we'll have someone contact you very soon to make sure we answer that for you. So we'll start off with one common one, I should say, that we saw, and this one captures that, is related to the new Bitcoin ETF. So and this question says, you know, the BTC ETFs began trading. Curious what your view is on BTC specifically, and cryptocurrencies, and generally as a long-term holding. Do you have a range of percentages that these ETFs should be in a portfolio or in a retirement account? Chris, that's a good one for you.
Sure, no, absolutely. Certainly the arrival of called spot Bitcoin ETF, which basically means you've got an ETF here that actually owns physical, sort of, something virtual or digital can be physical, but as close as it can, you actually own the the underlying claim on the Bitcoin, as opposed to futures or some of the other incarnations previously, companies that own massive hoards of Bitcoin. So it's a way to get exposure in a very, you can do it from any brokerage account, which is, nice. You don't have to worry about a crypto wallet or anything like that. So it sort of, civilizes the wild west of crypto in some regards. Makes it a lot more accessible, which I think is good and bad, like anything else. You can buy lots of things that show up on, a brokerage platform. Doesn't necessarily mean they're all great ideas or all bad ideas. I think, that idea of everything in moderation makes a lot of sense. We work with a lot of clients that do some investing on their own, and at this juncture, I've had very interesting conversations with folks inside the firm and outside. Some are very enthusiastic about it, seeing incredible potential over time. Others more skeptical, and the best way one of my colleagues described his perspective on it is, think about it a little bit like venture capital. And venture capital is really built around investing in what are generally earlier stage businesses. They're doing something very innovative, and a lot of it's the potential of what can it become. And venture capital is a world where you'll hit a couple home runs, and there'll be some spectacular flame outs and losses. And so long as you're cognizant of those risks, cognizant of the volatility embedded in that, it's not a own it, don't own it. I think it's thinking about how it fits in, with the other risks that you're taking within your portfolios. And again, I think this is one of those, opportunities to to work with someone like Robin or Dana or other financial consultants, to just thinking about how do you size these different investments. And in many instances, we're just talking about the the Magnificent Seven, and one of the concerns is sizing. Might they be too much of a portfolio? So I hesitate to say something is good or bad. You should own X percent or Y percent, but take into account the volatility, take into account what your particular financial situation is. What can you afford to lose on something like that if it doesn't work? And then the other part is, I think true with any investment, just keeping an eye on the sizing. If it, a lot of times we think about the downside risk, but we'll work with folks that over 20, 30, 40 years have stocks that have grown to become massive pieces of their portfolio, and they're sort of in this catch-22 where on the one hand you have these concentrated risks that you'd love to diversify, on the other hand it's in a taxable account, and you're going to go and hand a substantial chunk over to the IRS. So prudent rebalancing over time, maybe some gifting. I think those are, like I said, we think a lot about the downside, but also making sure that when investments work, they don't become too too outsized a share of your portfolio.
Well, and I recognize that we're up to almost the hour, but we'll stay on and answer questions, and there will also be a recording of this that's sent out after. So just want people to know that they'd like to stay on. We'll keep answering some questions here, and the next one will be for Robin. This one that I think you sort of touched on it earlier, related to Social Security. And so somebody mentioned 63 years old. What advice, semi-retired, what advice on taking my Social Security benefits now versus later? Seems money in hand is an investable asset to me. So what are your thoughts on that question?
Yeah, that is such a great question. And people will say, yeah, why don't I take an earlier Social Security? We don't know what's going on with the government. Will Social Security be down the road for me? I might as well get it now. And I can see that thought process. But the interesting thing, and you'll see this if you run the calculations on our website or with one of us in person, is that it's one of the few ways that the government rewards you for waiting. There's approximately an 8% raise if you wait longer. Some of my clients that really don't need that Social Security and they remain in a high tax bracket, even in retirement, wait until as long as possible. They're waiting until they're 70, right? And for them, it makes sense. Again, it's very much going back to, what do you need? What's the tax repercussion going to be? Right? How does that affect everything else? Are you still working or part-time gig in retirement? So it's very individualized, but the great news is not only does Social Security have some great resources for showing that, they used to send all of us paper statements. Some of us still remember that. Now you can just go on and log on online and see all of your credits, right? And what that would mean. And of course, we can run those numbers for you too. But don't jump into anything or take it too early because there's a lot of things that have changed where you can't basically back out and refile like you used to. So just be sure and you run the numbers before you make that decision for yourself.
Great. Oh, that's good. Thanks, Robin. Question here, Chris. Question is simple. Should we invest in tips? That's one that I think we've gotten quite a bit, obviously, with inflation, and so tips kind of getting a little bit more attention there. So what are your thoughts?
Yeah, no, absolutely. So I guess for the benefit of everyone on the call not familiar with TIPS, so TIPS are a Treasury inflation protected security. So it's basically it's a Treasury bond with that has the added feature that over time it will adjust for the realized inflation over the duration of its of the bond to maturity. Like most things, there's no real free lunch here. So what happens is these tips, while you have the inflation adjustment, as part of it, they also yield significantly less in most environments than a typical treasury bond. And so basically what you're doing is expressing a view, is inflation going to surprise? And so what you can do is you can actually look at the difference between the yield on a regular treasury and the yield on a tip of the same maturity, and you can compare those two, and you get what's called a break-even spread, and that is basically how much does inflation, have to come in at to make it a break even for accepting that lower yield on the tip. So if you buy a tip today, I think the break evens are on a 5-year. I think last I looked was about 2.5%. So you're making a bet that over the next 5 years, inflation is going to be higher than that. If it's less than that, you're actually better off holding the 5-year treasury with the which actually has the higher that higher yield today. So it's not all or none. Typically when we think about tips in our fixed income team, we're looking at relative value. We're looking at how wide is that spread? Are you getting paid are you getting paid an attractive spread over relative to regular treasuries to own those? So again, it's not again, I think this theme again, it's not all or none. We've owned them in certain environments, but even when we have them in our portfolios, that's not all we have in the portfolio. So that inflation hedging piece is beneficial, but it's you've got to view it in sort of the broader context of what your alternatives are. Certainly, right, if you had a tip that had the same yield as a regular 5-year treasury, you'd be crazy not to buy it, right? But what happens, right? Markets are efficient. They realize that this is there's an advantage with this inflation adjustment, and so markets being efficient, what do people do? You bid up the price of the bond, which is to say you're willing to own that bond at a lower yield. And so again, markets doing what markets do, which is take a view on things, and we're always looking for where are those relative values within the fixed income space.
Right. And the same with I bonds, which were really intriguing about a year and a half ago, and you could get a great rate on those. And I think what's an interesting sidebar to this conversation is so you can go online at treasury.gov and you can buy TIPS. Those are issued by the government, T-bills and I bonds. So there's that. Of course, you can always buy an ETF that bundles those. We sometimes are doing TIPS. But the flip side of that is some interesting questions I saw that were popping up during the webinar about the debt, right? Because we're actually funding the debt when we buy this from the government, and maybe speak to a little bit about that, because I do agree. I think that's something I'll occasionally see an article in the Wall Street Journal. I think there was one just yesterday about, okay, we feel like this is the elephant in the room. Nobody's addressing the national debt, and how does that affect all of this?
Sure. So I think the national debt is one of these factors that gets a lot of attention in some regards, and in others maybe not enough, because the impact is so slow moving, right? It is very difficult to draw a line in the sand and say, okay, if the debt gets past this level, X, Y, and Z are going to happen. One of the reasons is that we have the so-called exorbitant privilege of issuing debt that is payable in the currency we get to print, which is a really nice nice benefit. So certainly longer term you abuse that and you will suffer either weaker currency, higher rates, potentially both, as markets are concerned about what you're doing. But just as I mentioned, when we think about things like TIPS versus treasury, regular treasuries being a relative exercise, the same thing comes into play when we're thinking about currencies and debt, and and you look around the world, and in some regards the US is the best house on a bad block in terms of debt overall. On the other hand, one of the things that we've been thinking about is, given where we are today in terms of the where deficits are in what has been a growing economy. Generally, you think about fiscal policy as being countercyclical. You want to open the spigot when there's when there's trouble, help to sort of fill in those valleys, and then pull it back as you get into more healthier growth environments. That's really not the case here, right? We're sort of in very elevated deficits in what is overall been a growing economic backdrop, and so the capacity to do additional fiscal next time around may be restrained a bit. And so we think about that as potential risks on the horizon. It's not stuff that we will bake directly into an investment forecast, but one thing that we have been thinking about more, and how when we get to the point that we want to position more for this, is the idea that in the longer term we think there is the likelihood for more inflation than we've experienced sort of in the post financial crisis era up until the pandemic, where things tended to bounce around in that 1.5% inflation rate. So and that's motivated by a host of factors. We've touched on it before, but it's certainly demographics factor into it. There's a whole host of things, but that is a potential outcome going forward. And we don't think it's back to 70s style, but it's probably you know, numbers closer to maybe where we are today than where we were a decade ago. So it's again, very, very slow moving thing. If you looked at Japan, you would have thought that they would have cracked 10, 15 years ago. I can recall, you know, even starting, you know, way back in, you know, 2001, 2002 in the investment team, seeing some very, very compelling arguments as to why, you know, the US and, you know, certainly Japan were going to experience some pretty severe repercussions from their deficits in the next, you know, handful of years. And, you know, that's come and gone. It doesn't mean the risk isn't there, but it's something that's, you know, very, you know, very difficult, again, to make an all-in, you know, a forecast or, you know, investment position around, just given how slow moving these things tend to be. And again, it's just that relative nature, right? If you don't own US treasuries, whose do you want to own? Do you want to take the, you know, we had the Bitcoin question, right? I think the volatility of Bitcoin has, you know, convinced us maybe it's not a, you know, at this juncture, a suitable, you know, alternative, right? If I have something that's a dollar tomorrow, it's probably worth about $1 in, you know, any other currency the next day. You know, certainly as currencies become more and more, you know, or your alternatives become more and more volatile, they become less attractive as stores of value. So I think there's, you know, an important relative component when we think about the US debt.
Yeah. Great.
Interesting discussion. Yeah.
We'll squeeze another question in here and kind of trying to hit a couple different range of topics. But one is about gifting, and there's comments or at least the one poll talking about, you know, estate planning being sort of on people's minds. But you know, this one person asked, other than yearly gifting, what are some of the best ways to transfer money to grandchildren? So Robin, I know you've talked to people about this, I'm sure, many times.
Yeah, it's my favorite topic because it's so fun to work with people to gift to family or their favorite charities. And so we love having this discussion. So the annual exclusion, we should cover that real quick. That's 18,000 per donee for this year. So there's some interesting things you can do with that. But of course, what if you want to go above and beyond that, right? So don't forget, let's say you have a child, a grandchild, you're trying to give them as much as possible. If you give directly to, say, that institution, right? They're going to college, maybe it's medical bills, you pay that directly. That does not count against the annual exclusion. You can do some really fun things with 529s. You get a small state tax deduction depending on what state you're in. Some do, some don't, but they're really interesting. They're very low cost, and you can bunch 5 years of annual exclusion gifting into those. Those can also be passed down to other children. If, say, one child gets a scholarship, the other one does not, you can do more and more with those. They can now pay for student debt. There's a really interesting new law that's come out with the most recent Secure Act, where part of those 529s can actually be rolled to a Roth for the child to start that financial journey. So I love doing a lot of different things with clients depending on their particular portfolio. I have some people that have an overweight, again, Atlanta Coca-Cola stock, Home Depot stock, maybe from an executive. And instead of having that child inherit that at your passing, it's much more not only emotionally rewarding, but good tax and financial planning sense. Give during your lifetime. Give it to them. Often they're in a lower tax bracket. Help them sell it and diversify and start them. Really, the best thing you can give them is that financial knowledge of saving more than you spend, starting to invest a little bit, started sooner makes a huge difference. Just start that habit with your family, and that really can be a gift unto itself.
Yeah. Great. Well, I think, you know, we tried to hit on a lot of topics there. If we didn't answer a question, we will absolutely follow up and make sure we answer that for you. I think we've reached the end here. Thanks again, Chris and Robin. I want to also thank everyone for taking the time out of their day to be here with us. We'd greatly appreciate it if you could take a few seconds to fill out a survey that we have that you can see here on the screen, but also it goes linked in the chat section, so that you can. We'd love to have some feedback on this webinar and anything that we can do to improve, you know, this material and the webinars in the future. So also, if you're interested in learning more about managing a peer, please visit the link on the screen here that you can also see to schedule a call. We're also happy to provide a consultation where you can outline your financial plan and your entire situation and talk about some goals and what you have in mind for your finances. And then we'll prepare a comprehensive plan to review with you, and that can serve as a great way to outline next steps and to ensure that you stay on track as well. So please feel free to take advantage of that. So on behalf of my colleagues, Chris and Robin and Manning Napier, thank you again and have a great day.
Thank you, everyone.